Welcome, ladies and gentlemen, from me, Guy Monson, to our regular 6-minute strategy summary. After recent declines, 2022 is beginning to feel like a bear market in everything. We've seen falls in bonds, corporate, government and high yield, in equities across almost every region and led by Nasdaq, in exotic assets like cryptocurrencies, and when you adjust for the dollar, even in gold. All lost money this year in a near perfectly synchronized decline. Cash is currently king, but with UK inflation running at 9% and US inflation at 8.3%, the real return, of course, is substantially negative. Such simultaneous cross-asset declines are relatively unusual, and in this case have been triggered by three simultaneous events: sharply rising interest rates, of course soaring inflation, and weakening growth around the world, all of it amplified by the tragic war in Ukraine. In the slides ahead, we'll look at how to manage your portfolio in the face of a bear market in everything, and given that excess liquidity must ultimately find a home, we will consider which assets might rally first. Let's begin in the left-hand panel with looking at the performance of asset prices for the year to date. Gold down 1%, UK gilts down 9%, world equities in dark blue down 17%, Nasdaq in yellow down 27%, and Bitcoin in green down nearly 40% in just 5 months. On the right-hand panel, you can see the flight to the dollar, pushing the dollar index up to a 20-year high. That puts huge pressure on foreign markets and indeed foreign economies, especially the emerging world. All this in the bottom contributing to tighter financial conditions in the US and world markets. What's behind this, and why are these moves so extraordinarily synchronized? Well, of course, the first is an interest rate shock. We're getting rate rises much more aggressively than we would have dared to expect even a few months ago. Chairman Powell is very clear. He'll keep raising rates until he sees inflation coming down in a clear and consistent manner. And if that means taking rates beyond the neutral level, he will certainly do that. We see US rates topping out around 3%, in our more hawkish scenario 3.5%, and I think that's very possible. The second factor, of course, is the impact of inflation, particularly on the consumer. You can see there US CPI at 8.3%, UK soaring up to 9% and rising, and at the top there, G10 Inflation Surprise Index, which is still relatively elevated, meaning that a lot of inflation numbers are coming in ahead of analyst forecasts. On the right, you can see what this is doing to consumer confidence, sharply lower in blue in the US, and really very markedly lower in the UK, almost touching 2008-9 levels as consumers begin to react to the constrained spending power. Thirdly and finally, we've been used in these crises to China coming to the rescue and boosting growth and earnings. This time they're facing a confluence of shocks. The result is a sharp fall in red on the left in retail sales, down 11%. Manufacturing struggling, these are the PMIs, 50 is neutral, 46 indicates contraction. On the right-hand panel, the investment markets in China, the red, the China stock market index down sharply, and the blue, the yield on high yield bonds, still extremely elevated because people worry about bankruptcies in the property sector. Finally, the light blue chart is Shanghai subway passengers falling to zero as, of course, the lockdown bites. So is there any good news behind this all? Well, the first, I think, reasonably comforting factor is that equity valuations are coming down to more sensible levels. That bubble we saw in the pandemic years is beginning to fall away. I plotted on the left-hand side price earnings levels, multiples 1 year forward, and shown them against their 20-year average. World equities and US equities now back at the 20-year average, Europe substantially below. At the same time, corporate earnings are coming in surprisingly robustly, and particularly corporates are showing their confidence by putting through large share buybacks. On the right-hand side, I've shown the share buyback index soaring to 270 billion. So corporate cash flow is still surprisingly strong, and certainly the companies that are reporting to us relatively optimistic. The second, I think, factor that should give some comfort is that fund managers are exceptionally bearish. I plotted here cash levels in average funds around the market from the Bank of America Merrill Lynch survey, the biggest in the world. And you can see in May 22, we're running at the highest cash levels in funds that we've seen right back to March 03, almost 20 years ago. So a lot of that bearish feeling baked into markets. So what does this mean for policy when all assets are falling simultaneously? Well, the watchword is caution, and we're underweight most risk assets. We're strongly underweight bonds, but we do begin to see some opportunities in corporate yields today, particularly in bank paper. In equities, we're underweight, but again, we're beginning to see opportunities in some of the more defensive yield stocks, particularly consistent dividend payers. In alternatives, we're strongly overweight, really focusing on the regular inflation plus income which we get from our renewables and infrastructure, and considering also possibly adding to hedge funds where macro managers can manage these sort of market conditions. Against all of this, we're retaining a strong overweight in cash to protect portfolios against drawdown and be there for opportunities to buy. So these are disconcerting times, but as you can see, underlying corporate earnings are robust, valuations are beginning to normalise, and opportunities are emerging. So with a defensive asset allocation for the moment, I hope we can mitigate some of that downside, while also beginning to drip feed some money into real opportunities for the mid-term. Thank you.